Hey, welcome back. We're going to review our first quarter here with Horizon and our good friend Casey Hazen, our senior portfolio manager, there with us who helps us co-create all of the models here at Abundance. Also, want to let you know that we're in the process of rolling out some custom portfolios where you can actually have visibility to individual equities and basically continuing that relationship with them. And I can't tell you how fantastic they are because technically compliance won't let me do that. But I just believe that if they've done well by us with some of these other models, there's at least a chance that they could continue to do the same thing with individual equities because it's the same research. So as always, no guarantee of results. Past results are no guarantee of future results and all that type of stuff. But at the same time, I'm excited to be rolling that out. It'll be for certain clients, maybe not everyone's a good fit, but I'll be talking to you individually on a case-by-case basis to determine suitability. That said, Casey, glad to have you, man. Welcome back.
Yeah, thanks for having me.
Yeah, well, it's a great time to be getting together. We now are talking about tariffs and, President Trump. So you want to get us kicked off here?
Yeah, there is a lot to talk about. It's been quite a start to 2025 here. But yes, as it says here at the top, let's acknowledge the obvious. Tariffs have definitely been causing quite a bit of anxiety here in 2025. And really, it is tariffs that have been driving headlines and a lot of the market volatility that we've been seeing in equity markets, most noticeably. And this chart here just kind of shows really over the past 100 plus years what the average tariff rate on U.S. imports has been. Obviously, this hasn't been something that's been notable at all over the past, handful of decades. But really, what's most alarming or most noticeable is we went from roughly, 2.5% average tariff all the way up to, what would be 22%. So that red line there is obviously a huge spike. Don't actually know if that's going to be the end tariff rate. There's obviously a lot of uncertainty, and that's been leading to a lot of kind of nervousness on both the investor side as well as kind of like the consumer side as well.
So yeah, I definitely am getting a lot of feedback, a lot of questions, wondering how's the tariff going to play out? Is he just negotiating? Is he going to go hard line on certain things? Is this a continuation of the old trade talks from his previous presidency, even with China? Is this a bunch of grandstanding and saber rattling and things like that? So it seems like he's getting some results with nations who are willing to play ball. But that being said, how does this play out? I know we have some questions that China could take a little bit longer to get a more formalized deal, and they seem to be pretty staunch in their position. But what else is going on behind just this tariff talk?
Yeah, you're exactly right. I mean, that's what we've really been trying to figure out. The big question is this a negotiating tactic? And to your point, that's exactly what we saw in the first Trump administration back in 2018. And on the chart, you can see there was a little spike there from 2017 into 2018, but that was very much targeted in nature and very specific to China. What we saw with Liberation Day more recently at the beginning of April, that caused a little bit more of concern, and we did see a lot more market volatility because that brought in this idea that this could actually be policy going forward. The idea that this administration really thinks that implementing these tariffs and turning the U.S. economy back more focused on manufacturing is a way to improve our economy long term, which could very much be true. But what that would cause maybe in the short term is some pain, right? The
Yes.
idea of having a 22% tax in all essence on all imported goods would lead to decreased consumer spending. There's kind of no way around that. Even if, again, we're able to make some sort of headways, and maybe some of our companies are able to kind of take that on their margins. Maybe we're able to negotiate with our trading partners and reduce that a little bit. There's kind of no way around having some level of price increases, which would eventually lead to decreased consumer spending, all things equal. So really that's what's most focused on in the economy right now is, what's going to be the end goal of these tariffs? Is it actually going to be something that's going to be negotiated, and we're going to kind of come to an end rather quickly? If that happens, then we do think that this volatility will be short-lived. But the longer this drags on, the more of an impact this could actually have more medium term on our economy.
Yeah, no, I'm with you on that. I'm no economist, but at the same time, the more I dig into it, I appreciate some of the parity that he's trying to bring as it relates to how much we've been taxed or tariffed with these other nations. It's kind of insane what's been happening to us, but who's to say at what cost and how long the fallout could last. So, but I don't think that that's the only, while that's a big headline, that's not the only thing we have to talk about. What's the next piece that you have for us today?
Yeah, so while the tariffs are causing, a lot of uncertainty, that's really feeding through into sentiment on multiple different levels. So this first chart here just looks at the level of household uncertainty right now. So the top chart there shows a survey of U.S. households, basically asking the respondents, in a year, do you think that you're going to be in a better financial situation or a worse financial situation? And essentially, the gold line is respondents saying that they expect to be in a better situation. The green line is in a worse situation. Historically, over the past handful of decades, most people are optimistic about their future financial situation. And you can see over the last handful of months a pretty significant spike in respondents saying that they expect, to be in a worse financial situation. And the bottom line is the difference between those two. And you can see on that bottom chart, we're at pretty much the lowest levels there on household sentiment that we've been in, over this entire time period, going back to the early 90s. That's obviously very, very alarming because if consumers are worried about their future financial situation, what they're going to do is they're going to hunker down. They're going to decrease some of their discretionary spending. That's going to flow through into the economy, obviously, which, we know GDP here in the U.S. is made up of about 70% consumer spending. So if consumers pull back, that would very much lead to some sort of recession. And again, the longer this uncertainty goes on, kind of the closer we get to, the potential of a recession here. So that's more focused on households, but we're also seeing this flow through into other areas. This is a survey of business owners, so CEOs. Basically, how confident are you in the economy 1 year from now? Another big tick down. Again, that's very impactful for the economy because we know that if business owners are worried, they're going to cut back on their, capital expenditures. They're going to slow down on kind of hiring and investing in their own businesses. And that, again, could lead to some economic weakness. And then finally, and we've all obviously seen this, looking at, a survey of professional investors, do you think that we're going to see the economy weaken or strengthen in the next 12 months? We're at pretty extreme levels for professional investors thinking the economy is going to weaken. Seen that flow through into a lot of the equity market volatility we've had, most noticeably in the month of April. But yes, there's been a lot of negative, sour sentiment right now that we've been noticing. The good thing, and we'll definitely try to leave this on a more optimistic and kind of positive note, it is very important that we have not seen this negative sentiment, this uncertainty flow through into the hard data for our economy. And this is a chart here that's showing the labor market. And over the past many quarters that we've been doing these calls, we've talked about how strong the consumer is here in the U.S. particularly. And a big reason for that is our labor market has been exceptionally strong, really ever since, coming out of COVID. And that really hasn't changed even over the last couple of months when we had all this really negative sentiment. We haven't seen the labor market materially weaken. And a big thing that we've been focused on is kind of layoffs, because layoffs are really probably the earliest indicator that you have from a labor market perspective. The first thing that companies are going to do when they want to tighten their belts is they're going to kind of cut the fat and lay people off. While we've seen kind of specific companies and specific industries maybe lay people off, if you look at it over the entire economy and relative to kind of more normal times like before COVID, layoffs are right in line with a very healthy labor market right now. And so, what we have seen and what we've said and what we're expecting is if the labor market remains strong and the consumer remains gainfully employed, wages are rising, they're going to continue to spend their income, and that's going to continue to support our economy. Really, for us to feel really negative about the economy going forward, we would need to see the labor market kind of materially soften from here, which we're just not seeing in the data, at least not yet. And one last thing to point out, and I think this is something that's really positive, is we saw a lot of companies lay a lot of people off after COVID. And what we noticed was, in 2021, 2022, it was very, very hard for a lot of companies to actually hire people. And so we saw them having to go out and actually pay significantly more, kind of offer big signing bonuses, things like that. So it was a very tight labor market. And I think that's something that companies don't want to fall into that same trap. So kind of our expectation is that these companies are going to hold people on their balance sheet a little bit longer, just because they don't want to go through that same hiring process again, because again, they had to spend significantly more to hire the same quality people coming out of that last kind of uncertain period. So right now we're kind of expecting this to last maybe a little bit longer. And again, that will help us to stave off some sort of near-term recession, assuming we can get some sort of clarity around the tariffs and all the other noise that's going on right now.
Yeah, I appreciate that, Casey. Not that you need to go back to some of the previous slides, but I guess this month I started my 26th year as a wealth advisor, and for as long as I can remember, those University of Michigan surveys have been so important to have a really good gauge of what the consumer's feeling. And so at the same time, and I can't make a wholesale comment because every client's different, and also every client's response to what we've been doing as a firm has been different. There's been a lot of change that we've been making as an investment committee, including yourself and others on your staff, to proactively remove certain levels of risk. And so we've taken certain defensive positions. For some clients, we've moved into different models. And so I want to encourage you, if you're listening to this, that you may have been one of those people we've made those changes for. And if you're listening to this as a non-client and a prospective client, this is the type of proactivity that we have as a firm, with the support of Hazen and Casey Hazen and the rest of their investment committee, to be able to anticipate as best we can what's happening in the economy. From that place of anticipating what's happening in the economy, we do our best to make changes to the portfolio as proactively as possible. We're not day traders. We're not trying to get it right and make the right call. But so many of you have responded to our efforts, and we've moved from a traditional investment model to more cash flow. And so those cash flow models have more defensive positions. They may be more value oriented. They may be more dividend oriented. And what we've seen from some of the reviews that I've seen, and I can't say for everyone, that the downturn that so many would have faced if they were more traditionally allocated has been minimized because of that effort. So I can't say that we've got it right 100%. The timing can always be more perfect, and I can't say that we're going to get it right in the future. But even though some of these headlines seem a little bit worrisome, we're doing our best on our side to look out for you. And if you ever have concerns, as always, please reach out to us. It's always a good time to be sure that the risk that you're currently taking is in alignment with your long-term goals. I appreciate our efforts, especially when they work out seemingly for the moment. At the same time, there are some tailwinds that are hopeful. You have a lot of innovation still happening around AI. We have some deregulation, possibly some policy shift that might come from the presidency that could help us out. A lot of speculation about what will actually occur, of course. At the same time, I keep telling people, every time you think the world's coming to an end, it has this weird way of not. And so if you're concerned about what has happened in the first few months of the year, and you feel like whether it's the assets that we manage for you or the assets that you have outside of what are under our purview, we'd love to be able to engage with you and be sure that the current portfolio dynamic is right where it's supposed to be. If we need to make changes, that's what we're here for. Sometimes writing it out, because this is a marathon, not a sprint, makes sense. Other times, if you're closer to your goal or you're having an inordinate response to what is happening in the market, if you're uneasy unnecessarily, that's something we can do our best to create an environment where you can experience that peace. So also the other thing that I had a note here was We also have a potential change in some of the tax policy. So it was many years ago now when we leapfrogged Japan, and I believe we still have the highest corporate tax rate in the world. And so if you see some shift in the deregulation, if you get some tailwind from AI, if we possibly change some of the tax structure, that could be a benefit to a good bit of the populace. And Casey, to your point earlier, there can be some consumer sentiment based on what happened in the market, based on the headlines. I know I've got clients who are really concerned, but at the end of the day, if they keep earning what they've been earning and their savings keep piling up, the consumer has this funny way of consuming. So let's be honest, human nature is still human nature. So those things give us hope, but at the same time, we're doing our best to stave off any unnecessary risk, especially if it's not producing results. So if you guys have any questions, please feel free to reach out. We'd love to help however we can. We'll talk to you again soon.